All right, everyone. Thank you all again for being here. My name is Kyle. I'm a co-founder of the firm, and this morning we're going to be talking about how stablecoins are eating the world. Before we dive in, I have another fun, brief disclaimer for all of you. Please note that this presentation is for educational purposes only and should not be considered investment, legal, or financial advice. All right. There are 8 billion people in the world. And actually, interestingly, about 64% of the world's debt contracts are denominated in US dollars, despite the fact that only about 4% of the population is US, American. Debt contracts are very interesting as you think about money and network effects because debt contracts lock in a unit of account over time, frequently many years and oftentimes decades. Think about a 30-year mortgage. These long-duration contracts reinforce the network effects of money because they create a line item on the balance sheet of both the borrower and the lender. The borrower is going to have to rebuy that asset at some point to repay the loan, and the lender is going to mark their books with that asset in mind. Now I want to think about a question here. If you can denominate your wealth in any asset, what would you choose? Apple, gold bars, Bitcoin, dollars, whatever. Most of the people in this room probably do say the answer is dollars, but most people around the world, they don't currently denominate their wealth in dollars. But I suspect if you were to go to each of the 8 billion people on this planet and ask them that question without fear of persecution, for the answer, I guess somewhere between 4 and 7 billion of them would say US dollars. US dollars are the greatest product in human history, but amazingly, most people around the world who want dollars cannot get them because the legacy financial rails simply prevent them from doing so. Stablecoins are eating the world. The rest of this presentation is going to have 3 parts. Past, present, and future. So let's dig in. To understand stablecoins, we're going to have to first start with Bitcoin. Bitcoin was an innovation in fundamentally 2 different respects. The first is that Bitcoin is a non-sovereign asset. It cannot be printed by people or governments. It offers censorship resistance and encapsulates the ideals of Austrian economics, specifically with its very famous 21 million supply schedule. The second major element of Bitcoin is its use of public key cryptography and programmable on-chain contracts to create an opportunity for programmable money on-chain. This ultimately laid the groundwork for what we now call DeFi. Most of the discourse around Bitcoin is focused on element 1, but we actually believe that element 2 is more important. Bitcoin failed as cash, despite cash being in the title of the white paper, because it is not cash. Cash is what you use to buy coffee with, and more importantly, to denominate debt in. And no one denominates any debt in Bitcoin. Bitcoin is, like gold and many other assets, an investment asset, but it is not cash. So now let's get on to cash. There have been a lot of attempts at stablecoins over the years, starting with actually BitShares back in 2013, which I'm guessing most of you all have ever heard of because it obviously fell by the wayside. BitShares was actually extremely innovative in its design. It was the first to use decentralized collateral, oracles, and derivatives to try and enforce the peg. Ultimately, it did fail, but it was actually a really ambitious attempt, and BitShares would act as the inspiration for many of the earliest DeFi builders in the 2016, 17, and 18 era who built what is now the foundation of DeFi today. After BitShares, we had USDC and USDT, which are, of course, today the 2 big ones. Over the last year or 2, we've seen a resurgence in innovation around all things stablecoins, and those are pushing the boundaries of these systems in terms of access, product features, and a bunch of other cool ideas. I know to most people it certainly feels like the Circle and Tether duopoly is likely to persist in the future. We do not necessarily take that for granted. It certainly is possible that the status quo will persist, but there's also a real chance that the market structure is going to pretty meaningfully change in the years to come as we get regulation and as we grow from 150 billion in outstanding to 2 trillion in the years to come. All right, so where are we today? Well, first and foremost, we are at stablecoin all-time highs. There's about 178 billion or so in stablecoins, but this actually high is more important than the prior one. In the 2021 high, interest rates were 0. Today, interest rates are at 4.5%, which means all of these people holding these stablecoins are choosing to forego 4.5% interest rate to get stablecoins. That tells you a lot about the amount of value that people who hold these assets perceive. And of course, there's more than 100 million people who are now holding stablecoins around the world. I want to talk about some of the really cool product features in stablecoins. Most people think about stablecoins as a dollar on the blockchain, and obviously that is what they are. But there's a lot of really cool things you can do around that dollar that are not quite obvious. I want to highlight 3 of them here. The first is yield. Stablecoins are generally backed by US Treasuries, and US Treasuries provide a yield. It's pretty obvious that you try and create a product in which you can take some of that yield, or even all of it, and pass it back to the underlying holder of the stablecoin. With a blockchain, with a programmable ledger, you can actually do this in real time, meaning if you receive a token, let's say USDM from Mountain Protocol, the moment you receive that token from the counterparty, the number of tokens in your wallet can start accruing upward, increasing based on the accrued yield you're getting in real time. This is a really wow product experience because never before has anyone received money, looked at their wallet, and then 4 seconds later, the amount of money in their wallet just increased. And it's a very, the first time you use your iPhone, you swipe on the screen, you're like, wow. And it's really a moment that will change people's perception of money and how they should interact with money forever. The next major feature I want to highlight is on-chain confidentiality. PayPal launched their stablecoin called PYUSD earlier this year on Solana a few months ago. And it uses a new feature in Solana's token extensions called confidential transactions. And that enables you to cryptographically hide the amount of money that you were sending from person A to person B. This still also allows PayPal, as the issuer, to decrypt those balances if necessary for law enforcement or compliance purposes. But anyone who's just looking at the blockchain on the public ledger won't be able to see how much money is moving around. Obviously, if we're going to get to scale, both for payments for people buying coffee or whatever, or if we're going to get large-scale settlements between banks and institutions, we're going to need this kind of a thing to work. And last, I want to highlight some of the meaningful improvements we're seeing around stablecoin APIs, both in the USA and abroad. In the US, Stripe just acquired Bridge for more than $1 billion. And Stripe and Bridge makes APIs that make it really easy to move stablecoins and dollars back and forth. Some of Bridge's customers include companies like SpaceX, Deal, and Scale.ai, who use this to pay their contractors all over the world. Speaking of Bridge, I want to highlight one of the most awesome product features that just announced that most people are not quite following. This launched just a few days ago, and it was done in conjunction with Coinbase Wallet. You can now receive self-custodial USDC to your wallet by a bank wire, meaning you can give someone else can send money to a routing address and account number, and you will receive USDC in your self-custodial wallet. This effectively makes the transition from legacy system to stablecoins seamless for users. This also works in reverse as well, meaning you can send USDC from your self-custodial wallet to a routing number and an account number. This is going to roll out across all the major crypto wallets in the months to come. I just highlighted a couple of cool new stablecoin product features on the last couple slides, and there's a couple more I want to highlight here, mostly around the Solana token extensions. Solana token extensions provide a library of features that are live on mainnet today to enable tokens themselves to do these cool new features and functions that, again, are not obvious at first sight, but actually very powerful to scale these systems. The first is transfer fees. This means we can now have the ability to programmatically enforce taking a fee every time you either transfer a token or trade a token. We think this could have a lot of applications in any sort of stablecoin business or payments. You could imagine even equities or other kinds of investment assets implementing something like this as well. You could have conditional logic. So it could be, hey, if you hold this asset for more than a year, you get a bonus. And if you hold it for less than a year, you get penalized when you sell it. There's all kinds of really cool logic you can build on a system like this. The other really powerful feature is what's called transfer hooks. Transfer hooks allow you to run logic either before, during, or after a stablecoin, a token transfer. The most obvious use case for this is KYC. We have the BlackRock Biddle Fund. We have all these other products coming online around the world. And if we're going to have these tokenized fund products, we are going to need to have KYC enforcement on chain. And transfer hooks allow you to do KYC natively on the blockchain. We believe all of these kinds of features are going to be instrumental in getting us from 150 billion, 180 billion in stablecoins today to trillions in the years to come. We're going to need this kind of infrastructure to get there. All right, so what's next? Well, there have been, of course, regulations, the big one, so let's touch on that. There have been various stablecoin bills that have been authored over the last few years in the House and the Senate since 2022, but none have passed so far. Senator Haggerty, who we're going to be talking with pretty soon, actually authored the most recent bill, which was socialized in October. In our conversations with politicians and their staff on both sides of the aisle, we actually don't see much disagreement about the substance of these stablecoin bills. We're generally pretty optimistic that one of these is going to go through. We don't know exactly which one. but we can say we've reviewed all of them, have provided our input on all of them, and we are generally happy with the content and substance of them. I think we'll get something here pretty soon. Next, I want to talk about banks. Once we get legislation from Congress, that will make it possible for banks to hold these assets. Today, major US banks are effectively not allowed to touch stablecoins. Kind of a couple of major things I want to highlight here. The first is it's pretty likely that some of these banks are going to become stablecoin issuers themselves. Looking at the profits for Circle and Tether, it's going to be too tempting of an opportunity for them not to go after that. We think this is going to be really important to legitimize stablecoins in the eyes of governments and people and companies around the world. A lot of people don't know what Circle and Tether are, but everyone knows what JP Morgan is and Bank of America. And when you can say JP Morgan has a dollar on the blockchain or Bank of America has a dollar on the blockchain, that's going to really increase, I think, demand for people around the world to want to hold these assets. The second obvious kind of follow-on from that is that the banks should enable deposits and withdrawals of stablecoins. Building on my comments about Bridge a few minutes ago, this is going to make it even more seamless to move from fiat to crypto and back. Today, I'm assuming most of you all have tried to onboard onto Coinbase and get money on, and the process of, wire from bank to Coinbase, convert to USDC, it's a huge pain. And I think we're going to get that process will get embedded in bank workflows pretty soon. This next slide here is probably, I think, the most important one in the presentation and one I think people don't think enough about, which is the big tech companies. If once these guys all have the green light to move forward, the rate and scale at which stablecoins can proliferate around the world is going to be pretty unprecedented. This is going to be possible because all of these companies have hardware, have fast internet, have secure enclaves, have people who are trained to have wallets on their phone and have money on their phones. We have all of that stuff in place. The last thing we really need is basically key management and embedding stablecoins in the wallets and their phones. There are about 8 billion devices around the world. For context, there's about maybe 300 to 500 million people who are estimated to hold crypto today, and those are people who had to go out of their way to download a crypto wallet, write down 12 or 24 words, and do that whole song and dance. Obviously, that's a lot of pain. As the major phone providers, Apple, Google, and Microsoft, roll this out natively in their operating systems, that number is going to go basically overnight from 300 or 400 million to 8 billion. Of course, there's Facebook or Meta. Facebook very famously tried to launch their Libra project a few years ago. They were unfortunately not allowed to launch it. The US government actually stopped them from launching it. But Facebook was very clear what their ambitions were. They, as a global company, feel the pain of interacting with all these different financial systems around the world. And they wanted, instead of having to interface with 50, 100 different financial systems, they wanted to have a single global open money movement system that they can embed across their family of apps, including WhatsApp, Facebook, and Instagram. If you look today at all of the commerce features, in particular in Instagram, it's very clear that there's just a tremendous opportunity for Facebook here, and they're going to push to make it happen because it's going to save on their operational costs dramatically. Of course, we have Twitter. Elon has been very clear in all of his public commentary for years now that he views as X as the everything app, and that he wants to embed financial services directly in the app. He has not really elaborated on what that means, and so we don't know exactly what he's going to do, but we talked to a lot of the folks around Twitter or X, and we know that they want to do crypto as soon as they feel that they have blessing to do so. And then, of course, there's Telegram. Telegram has about 1 billion users today. They started to roll out some crypto features earlier this year, but it's still kind of beta and kind of wonky and not available to Americans. We think as these guys can roll out crypto in their respective apps, it's going to completely change people's perceptions of stablecoins and how to access these systems. When stablecoins again really hit, they're going to hit fast. Now, of course, we are in the business of providing returns to all of y'all, and unfortunately, buying USDC or USDT does not really do that. And so we need to figure out some ways to profit from all of this. So I want to talk a little bit here about some of the opportunities we're looking at and investing in. The first are peer-to-peer exchanges. Most of the 100 million people around the world who own stablecoins today have acquired them through P2P exchanges in these various emerging markets. What is a P2P exchange? You can basically think of Craigslist. That means you're going on a website, you're doing a manual listing, you are negotiating via text box with another person. Sometimes you go meet them physically, and the user experience is terrible, as you can imagine, and fraud is rampant. There is no protection. When person one sends money, you have no guarantee that the other guy is going to reciprocate. And so it's just a huge pain. This happens across the major Asian exchanges, Binance and OKX, host P2P exchanges These are loss leaders for the business. The products are terrible. There are millions of Telegram, WhatsApp, and WeChat groups around the world that people do these P2P exchanges on. And we think there's a massive opportunity to update the system. Using recent advancements in AI and in cryptography, there are now teams who can basically take all the benefits of a P2P exchange, meaning no central clearinghouse, and automate all of these processes to get rid of the fraud and to offer an incredible user experience for people. We've already invested in 2 of these out of our venture funds. One is focused in LATAM and one on India. We think there's going to be more of these around the world, and they're going to be mostly regional winners because the product and go-to-market focus for this is going to inherently be pretty regional. The second, obviously, are issuers. We invested in one issuer called Mountain Protocol earlier this year. Their asset is called USDM. The largest stablecoin issuers, Circle and Tether, are not providing yield from the underlying treasury holdings back to stablecoin holders. This is actually because in the United States today, passing yield on to a holder is explicitly a securities transaction, and so this is not allowed under the SEC today. The team at Mountain Protocol figured out what we believe is the best regulatory path for creating a prudentially regulated stablecoin in the island of Bermuda that passes back to yield to non-American holders. The product is live today with about 100 million outstanding. For those of you wondering why Bermuda, Bermuda actually is where most reinsurance around the world is based, and they actually have a very strong and robust framework for a lot of advanced financial regulations. The third opportunity is banking as a service APIs. Over the last decade, with the rise of fintech, a ton of companies around the world have raised money to build out banking as a service functions or finance APIs. The goal of this has been to basically take finance and advanced financial services and embed them in all kinds of applications that are not strictly financial applications. One of the core insights we have learned from one of our portfolio companies, which is called Squads, Squads is the leading multi-sig on Solana today, is that basically all permissioning functions across every banking API is just a set of permissions on the Squads protocol. We believe that there are going to be a new wave of these kind of banking as a service APIs that build on top of the Squads protocol, and you're going to embed these in all kinds of stablecoin-based applications around the world. Fourth is FX. This one's pretty obvious. As more countries issue stablecoins, FX markets are going to natively appear on chain. We do have Euro stablecoins that have been live for 6 or 9 months now or so, and there's actually a decent amount of liquidity on the USD Euro pair on chain. As liquidity grows for these on-chain pairs, we think this is going to see pick up and uptake from both retail and institutions. For retail, it's going to be pretty obvious. Everyone knows the airport fees for doing FX is terrible, and the fees you're going to get doing this on-chain are going to be very low. For institutions, the benefit's going to be settling times and cost. International bank wires are known to be very slow and expensive, and if you're an institution trading and dealing with risk and counterparties, you're going to be able to go from several days or even potentially a week of settlement time down to a few seconds. It's going to be a major improvement for hedge funds, trading funds, commodity firms all over the world dealing with FX issues. We also expect, as this liquidity grows, that all of the major remittance companies like TransferWise, Western Union, and others are all going to tap into this on-chain liquidity and further accelerate this. And then the fifth is going to be around wallets. People are going to hold these stablecoins in self-custodial wallets. As more of those wallets store more value, inevitably people are going to do more stuff in those wallets. They'll do trading, they'll pay subscription fees for whatever, they'll just use these things more. The wallets, as the front end in which people access these, are going to be in the prime position to capture value from this. We think this is one of the most overlooked opportunities in kind of thinking about proxy ways to go along stablecoins, and we've been trying to figure out more and more ways to get exposure to wallets. Tushar is going to talk even more about this in his presentation here right after me, thinking about where wallets fit in the stack. Before wrapping up, I would like to talk about the strategic importance of stablecoins to US interests. By simply enabling and encouraging all of the companies I've talked about in the prior slides to encourage people to buy stablecoins, we're going to be exporting USD to people all over the world. And this is ultimately going to explicitly harm most, if not all, of the US's major enemies around the world, including Russia, China, Iran, North Korea, etc. The people in those countries, if they are choosing to exit their local fiat currency and buy US dollars, they are choosing to ultimately reduce the economic wealth of their respective countries and increase the economic wealth of dollars. This is a way to advance US interests that requires no guns, no war, no sanctions, no tariffs, doesn't even require coordinating with anyone in Europe or any other allies. It just requires changing a policy and encouraging capitalism to work. This is really capitalism at its finest. We have a product that everyone wants. It's called dollars, and we just need to encourage all of the great American software and technology companies and banks around the world to go and export this thing to people who already want it. And this will happen from the bottom up. Next, there's been a lot of discussion in recent years about global trade moving off of USD, especially in BRICS countries around the world. A lot of talk about oil trade and RMB and stuff like that. Stablecoins can at least help partially mitigate that. As I noted at the beginning of this presentation, the key thing that makes money is if people denominate debt contracts in it. If more people have stablecoins, that means more people are going to inevitably denominate more long-term contracts in dollars instead of in RMB or any other currency. And lastly, stablecoins actually help us control inflation. If people are choosing to exit their local fiat currencies and get stablecoins, that means we are creating incremental buyers for treasuries, and that means we're changing the price ratio between USD and other fiat currencies. This is going to ultimately reduce the cost of imports for Americans, which will help dampen inflation. So it's good on a lot of respects.